Swayam Prabha. Digital India. Educated India.
Yogah karmasu kaushalam.
Hello everyone, I am Dr. Chetna Marvadi, Assistant Professor, School of Commerce, Gujarat University. In the previous part 5, we have acquired information about number 1, absorption of administration overhead, number 2, absorption of selling and distribution overheads, number 3, meaning and impact of under and over recovery, number 4, application of absorption or recovery rate. In this part number 6, we will be continued with application of absorption or recovery rate, and we will discuss about some special items where those items are to be included or excluded in cost accounts. All these we will understand with arguments. Let's understand first question on application of different recovery rate. Swadeshi Company Limited has provided data to you of factory operations. Direct material consumed rupees 1,80,000, direct wages rupees 1,50,000, factory overheads chargeable to the department rupees 1,26,000, labor hours 12,000 hours, machine hours 10,000 hours. A company has received one special order for which data is made available. Material consumed rupees 30,000, direct wages rupees 24,750, labor hour worked 1,650 hours, machine hours worked 1200 hours. Determine number 1, recovery rate of factory overhead, number 2, amount of factory overhead for special order, and number 3, total cost of order under different methods. Methods to be used are number 1, direct material cost percentage, number 2, direct labor cost percentage, number 3, labor hour rate, number 4, machine hour rate. Let's prepare solution. First of all, asked recovery rate will be calculated. First we will calculate direct material cost percentage, and its formula is factory overhead divided by direct material cost into 100. Factory overheads given is rupees 1,26,000 divided by direct material cost is rupees 1,80,000 into 100, which will give us 70%. Therefore, factory overhead is 70% of material cost. Next, we will calculate direct labor cost percentage. Formula is factory overhead divided by direct labor cost into 100. Factory overhead given is rupees 1,26,000. Direct labor cost is rupees 1,50,000 into 100, which equals to 84%. It means factory overhead is 84% of direct labor. Next we will calculate labor hour rate, and the formula is factory overhead divided by labor hours. Factory overhead given is rupees 1,26,000, labor hours are 12,000. Therefore, our rate per labor hour is rupees 10.50. It means that factory overhead is rupees 10.50 per labor hour. Next we will calculate machine hour rate. Formula is factory overhead divided by machine hours, that is 1,26,000 divided by 10,000 machine hours, which will give us rupees 12.60 per machine hour. It means factory overhead is rupees 12.60 per machine hour. Now, we will calculate chargeable factory overhead. Calculation of factory overhead chargeable to the order. Let's prepare solution. Calculation of factory overhead chargeable to the order under all four methods. First, factory overhead to be charged under percentage of material cost method is 70%, that is 70% of rupees 30,000, which is rupees 21,000. Under second method, percentage of labor cost, it is 84%, that is 84% of rupees 24,750, which is rupees 20,790. Under third method, labor hour rate, our rate we have calculated is rupees 10.50. Therefore, 1650 hours into rupees 10.50, which will give us rupees 17,325. And last method is machine hour rate. Rate calculated is rupees 12.60 per machine hour. Therefore, 1200 machine hours into rupees 12.60, which will give us amount 15,120. Let's prepare total cost of order under different method. Direct material and direct labor cost given in the example. So, direct material is rupees 30,000, which will remain same under all four methods, and direct labor given is rupees 24,750, that will also remain same under four methods. We will add in that factory overhead under first method, percentage of material cost rupees 21,000, under second method, percentage of labor cost rupees 20,790, under labor hour rate method 17,325, and under machine hour rate method 15,120, which will give us total cost under first method of percentage of material cost rupees 75,750, under percentage of labor cost method 75,540, under labor hour rate method 72,075, and under machine hour rate method 69,870. Financial accounting and cost accounting are having their own set of rules. Financial accounting is based on mercantile system. It reveals actual profit based on mercantile system. Cost accounting does not consider any notional items. So, certain items which are considered or not considered in cost accounting. Now, we will study those special items for which cost accounting has its own arguments. Let's see treatment of special items of overhead. First one, interest on capital. There is a considerable difference of opinion on question as to whether interest on capital should be included in cost or not. This is so because whether a concern pays interest on capital or not depends upon its capital structure. This means a company raising finance by equity capital only has not to pay interest, whereas a company raising finance partly through debenture has to pay interest. If interest actually paid is included in cost, companies not paying any interest will have lower cost and companies paying interest will show higher cost of production. This makes difficult the comparison of cost in different companies. Therefore, for the sake of uniformity, either interest paid should be excluded from the cost, or alternatively interest on total capital employed, both equity and debenture capital should be included in cost so that cost become comparable. Let's discuss about inclusion and exclusion of interest for cost determination. For inclusion of interest, the main argument in favor of including the interest in cost are: first, in line of production factor. Labor, capital, land, etc. are different factors of production. Wages are the reward of labor, rent is the reward for land, and interest is the reward for capital. As we include wages and rent in the cost, so interest should be included. Second factor is time period, where interest is included in cost. Due regard is given to time factor, which is one of the most important factors in production. For example, for building construction contract, a company takes 2 months and that of contract B, company takes 1 year. True cost of these contracts cannot be compared unless interest on capital locked up is charged to this contract. Third, nature of machines. It is necessary to include interest if comparisons are to be made between different processes and operations. For example, cost of products or services provided by the expensive machine cannot be compared with the cost of products of a less expensive machine unless interest is included in cost. Fourth, machine based or manual based production process, where the management has to decide about replacement of manual labor by machine. A true comparison of cost of these two methods cannot be made unless interest on the cost of machine is taken into consideration. Fifth, value of different articles, where articles of different values are produced and capital invested in each varies considerably, inclusion of interest is of special importance. 6. Status of stock investment. The true cost of maintaining heavy stocks cannot be ascertained without giving due consideration to interest on capital locked up in stocks. For exclusion of interest, arguments are usually advanced against including interest in cost. First, economic versus costing. The argument that interest is the reward for capital as wages is the reward of labor and therefore should be included holds good in economics and not in costing. Second, financial cost, not operating cost. Interest is a matter of internal finance and therefore should be excluded from the cost. Whether work is done by own capital or borrowed capital does not affect manufacturing cost. However, it affects the balance of profit. Third, allocation of interest cost. It is quite difficult to determine the exact amount of capital upon which the interest should be calculated. This is because working capital in the form of stock, debtors, cash, etc. changes every now and then. Fourth, precise interest rate. It is also difficult to determine a fair rate of interest as market rates of interest vary considerably. Fifth, complicated issue. Managerial decisions and comparisons involving interest can be best made on separate statements without introducing interest in cost accounts. Inclusion of interest in cost accounts create unnecessary complications. 6. Inflated cost of stock. Inclusion of interest inflates the value of work in progress and finished stock, which implies an inflation of income to that extent. Let's conclude. After considering the argument for inclusion and exclusion of interest in total cost accounts, it can be concluded that number 1, interest should be excluded from cost account, and number 2, interest should be considered while making cost comparison for managerial decision making. Second term is cash discount. Cash discount is recognized as a form of interest. It is a financial cost. Therefore, treatment of cash discount in cost accounts depend upon the way interest on capital is dealt with. Like interest on capital, cash discount is also generally not included in cost accounts. Third, carriage inward. This is directly connected with the purchase of materials and is generally included in cost of materials purchase, thereby treating it as a direct cost. Alternatively, it may be treated as an item of factory overhead. Fourth, packing expenses. Packing expenses may be of 3 types. First, packing which is necessary for handling of product, for example medicines, oil, other liquid products must be packed to make them sellable. Such packing expenses are treated as manufacturing cost. Second, fancy packing meant to attract customers. For example, colorful attractive wrappers of cosmetics are a form of advertisement and should be treated as selling overhead. Third, packing that facilitates transportation of products to the customer's place. For example, packing of television sets or refrigerators should be treated as distribution overhead. Next item is defective or spoiled work, where defective work is inherent in the process of manufacture. It should be included in the cost of production as normal loss. If defective work arises due to abnormal factors like fire accident, machine breakdown, etc., the net loss should be charged to costing profit and loss account. Next is setting up cost. After the completion of a particular job, machines require setting up with a different set of tools for taking up the next job. The cost of setting up time is therefore normally charged to that particular job for which the preparation is being made. But when the setting up is frequent and cost abnormally high, the situation demands proper measurement and control of setup cost. In such cases, it may be preferable to treat such cost as production overhead for booking against all jobs equitably. Next is depreciation. Depreciation is the decrease in the value of fixed assets due to use and or the lapse of time. Depreciation forms a part of the cost of production, and accurate cost of producing an article cannot be ascertained if depreciation is not taken into consideration. Therefore, various methods of charging depreciation, for example, fixed installment method, reducing balance method, machine hour rate method, sinking fund method, annuity fund method, etc. In cost accounts, depreciation is generally charged according to machine hour rate method and sometimes by fixed installment method. In machine hour rate method, production hour rate method, depreciation is charged at a rate per hour of machine operation. Depreciation charge per machine hour is calculated with the help of formula, that is, depreciation per hour is equal to cost of machine minus scrap value divided by estimated life of machine in hours. This method has been commonly used in the illustrations on machine hour rate. Next is obsolescence loss. Obsolescence is one of the causes of depreciation. The term obsolescence should therefore be distinguished from depreciation. Obsolescence is the loss in the value of an asset due to its suppression at a date earlier than foreseen due to factors like change in product or method of manufacture, etc. Obsolescence occurs not only in respect of fixed asset but also for the items like materials. A company may make a separate provision for obsolescence loss besides providing for depreciation. In the absence of any such provisions or such provision falling short of actual obsolescence loss, such loss or shortfall as the case may be should be charged to costing profit and loss account. Next is plant repairs and maintenance. Regular repairs and maintenance are charged to production overhead to be apportioned to various departments on the basis of plant values or machine hours worked. In case there are major repairs and overhauls, such cost should be capitalized as it adds to the capital value of the assets. Next is fines realized from workers. Income from the fine realized from the worker is not included in cost account. As per the provisions of Payment of Wages Act, fines realized from the workers are credited to the fines fund and utilized for the welfare of workers. Next is idle capacity cost. Idle capacity is that part of the capacity of a plant, machine or equipment which cannot be utilized profitably. It refers to idleness because of low production due to lack of orders from customers, absenteeism, shortage of materials, etc. It is a temporary phenomenon and can be wiped out when difficulties causing idle capacity are overcome. idle capacity is to be classified into first normal and second abnormal. If idle capacity is normal, that is, it can't be avoided, then the idle capacity cost may be absorbed in cost by inflating the rate. But if idle capacity is caused due to abnormal reasons such as faulty planning, power failure, etc., the cost of idle capacity should be charged to profit and loss account. Next is leave wages. Each worker is permitted a specified number of leave with full pay during the year. The cost of paid leave cannot obviously be charged to any job or cost unit since no work is done during this period. Therefore, the wages for the leave period not treated as indirect labor cost and charged to factory overhead. An alternative method of treatment of leave wages is to charge the same as direct labor cost by inflating the hourly rate of wages. This is done by estimating in advance the amount of leave wages and spreading it over the actual number of working hours to give an inflated hourly rate. Next is royalties and patent fees. Royalties may be payable for first making use of a patent process or component in the course of manufacture, or second, the right to sell the finished product. Royalties payable for making use of a patent process in the manufacture should be treated as direct expense. It is payable at a rate per unit and included in prime cost. Royalties payable on the basis of sales should be regarded as selling cost. Next is research and development cost, where such cost is incurred for a particular function like production or sales, it should be charged as overhead to the respective function. But when the research and development costs are included in connection with a particular job order, it should be treated as direct charge to the job only. Where, however, research fails and does not produce any fruitful results, it is treated as an abnormal loss and charged to costing profit and loss account. Next is fringe benefits. These are the benefits given to workers in addition to basic wages and dearness allowance. These benefits are not related to the quantity of work done. These include first, medical facilities, second, canteen facilities, third, sick pay, holiday pay, leave pay, etc. Fourth, pension and other retirement benefits, etc. The cost of such benefit should be treated as production overhead, which are allowed to various departments. The usual practice is to estimate the cost of such benefits for the whole year and make a proportionate charge to each period. This avoids uneven charge to various periods. Next is drawing and design office cost. Drawing cost may be treated as direct expense if drawings or designs are prepared for specific jobs. In case drawings are to be enclosed with sales tenders, it may be treated as selling overhead. Where drawing and designing office is used as a service department, its cost should be treated as factory overhead and apportioned to production department on the basis of technical estimates of services rendered or on any other suitable basis like number of drawings made, man hours worked, etc. Next is inspection cost. Many companies have separate inspection departments. Such a department is a service department and its cost is apportioned to production departments on the basis of services rendered or time spent by the inspection staff. Next is bad debts. Some cost accountants are of the opinion that bad debts are financial losses and thus excluded from cost accounts. If, however, bad debts are included in cost, it should be treated as selling overhead and may be apportioned to various products on the basis of credit sales of products. Abnormal amounts of bad debts which are of exceptional nature should not be included in cost accounts. Next is cost of small tools. Cost of tools may be treated in any of the following method. First, small tools are charged off as an expense at the time of their purchase. This method is simple and thus more commonly used as it does not require any record of tools in stock to be maintained. Second, cost of small tools is capitalized and debited to small tools account, treating it as a fixed asset. Depreciation is then charged on annual basis on this fixed asset. This method is not in common use. Third, small tools purchased are charged to store's inventory. Whenever any tools are requisitioned by any department, these are charged to the requisitioning department as revenue expense. Next is expense of cost accounting department. These costs are generally charged to administration overheads. Sometimes cost office costs are apportioned to various functions, that is production, administration and selling and distribution on the basis of estimated benefits obtained by each department. Next is profit sharing bonus. As a matter of principle, profit sharing bonus is payable out of profits and is thus an appropriation of profit. It should therefore be excluded from cost. In India, however, the payment of Bonus Act of 1965 makes it obligatory to pay a minimum bonus of 8.33% to employees irrespective of profit or loss. The amount of minimum bonus should thus be treated as overhead and any bonus over and above that should be treated as an appropriation of profit. Some cost accountants prefer to treat the entire amount of bonus as overhead and apportion it to various departments on the basis of wages of each department. Next is market research cost. Market research include study of tastes and habit of customers, future trend of demand, potential markets, competitive products, trading practices and channels of distribution. The expenditure on market research is in the nature of policy cost and depends upon the policy of management in this regard. Many concerns do not spend any amount under this head while others spend heavy amount on this item. Market research cost is normally treated as selling overhead. Next is canteen expense or subsidy. Where canteen runs on a subsidized basis, it is welfare measure for the staff of the organization. Such an expenditure on subsidy is an overhead cost and is apportioned to various departments on the basis of total wages or number of workers. When canteen runs on no profit, no loss basis, there is no question of any expenditure being incurred. There are certain issues for which different views prevails. It is very interesting to know the views of different experts about these issues. But when subjectivity exists for any issue, it is not possible for maintaining uniformity and comparability. Therefore, in this part, we have discussed about all those issues which have some degree of subjectivity and how it is to be dealt in cost accounting is studied in this part. In addition to this, in the beginning of this part, the question on application of different recovery rate is also studied and how this different recovery rate affects total cost is also studied. In the next module number 7 of overheads, we will discuss about meaning and type of capacity levels, which includes maximum or installed capacity, practical and operating capacity, normal capacity, capacity based on sales expectancy, actual capacity, ideal capacity. The knowledge about capacity levels is very essential to the learner of cost accounting because this knowledge provides better understanding to determine cost of product or services will be discussed in the section 1. And in section 2, we will discuss another emerging issues pertaining to overhead recovery, which is activity based costing. Activity based costing is known as ABC. ABC concept deals with one of the important component, that is overhead. In case of overhead, under traditional costing system, recovery rate is determined through the formula total fixed cost divided by normal production. But under ABC costing emphasizes on activities, and through activities recovery rate is determined. The basic understanding provided in section 2 for ABC. Section 2 covers number 1, meaning of activity based costing, number 2, terminologies used in activity based costing, number 3, understanding about cost driver, number 4, practical understanding for activity based costing approach, and number 5, difference between traditional approach and activity based costing approach. We will meet for part 7. Thank you.